the Online Collections Technology Think Tank 4.1. Thank you for those who've joined us earlier today. We hope you've enjoyed our discussions where we looked at value of communications, collections risk, measuring affordability and vulnerability, and now we're going to move on to the cost of living challenge shortly. Some really good discussions. They are recorded, so if you've registered, recordings will be available. I'm not sure when, but they're usually within a week or so at the very latest, so hopefully you enjoy them. We do actually repost these events on our YouTube channel as well. We've got a good backlog on there if anybody wants to ever have a look and want to see what was happening last year or a couple of years ago, although everything changes so quickly. I'm not sure of the relevance sometimes, but anyway, have a look at that if you like. But just a really quick one from me before we move forward. Just want to, anybody who hasn't joined us before, just want to say about engagement. Have a look at this platform. Left-hand side, there is some icons. Have a look at those, information on speakers. You've got links to our future events. Have a look at that as well. I'll talk about those at the end. And then some information on our speakers. But more importantly, we've got a chat box. So we'd love for you to ask questions if you can. We'll put them to our panel and chair. If we manage to cover them off, then that would be great. But if we don't, we'll be writing a review of this event next week. We'll round up some questions. So look out for that. That'll be on the Credit Connect website next Thursday. But for now, let's move forward and let's talk about the cost of living challenge. Chris Warburton's is going to chair this session. So I'm going to hand over to Chris and we can move forward and hear what our panelists think. Chris, over to you.
Thanks, Colin. So yes, we've had three really interesting discussions. So this one here, well, we've already talked about cost of living quite a bit already, but this one here is specifically on cost of living and the cost of living challenge, with really a bit of a focus around, you know, what are we seeing, but then also what needs to be done about it as well. You know, and what response should we have? So with me for the last discussion, we've got three great speakers, you know, going to join the panel. We've got Jamie Buckley, who's the Senior Partner and Development Management Manager for StepChange, so obviously in the free debt advice space. We've got Ian Parry, who's an advisor and the CEO of Future Leaders, and obviously an advisor, particularly in the water and the utility space. And last, we've got Kevin Still, who's a principal consultant and director of DEMSA, with expertise in collections, and obviously from a DEMSA point of view across debt advice as well. So, so the three of you, welcome. Thank you very much for joining. It's going to be an interesting conversation. And I suppose, you know, to kick off, I suppose I was going to come to you first, Jamie, just really ask a little bit about what have you seen from cost of living? I mean, we've talked about it already. It's been in the press quite a lot, but what's the latest on the ground in terms of what you've been seeing for your members and customers, I suppose?
Yeah. Afternoon, everyone. Thank you for having me. So unsurprisingly, we've seen unprecedented demand. So give you a flavour of that, really. So in January, we saw record website visits. So it's almost 700,000 visits. So new client contacts have doubled year on year. I think a really sobering statistic, we had 3,000 people visit and complete debt advice on Christmas Day, which kind of gives you a flavour of where we're at. Cost of living is a huge driver behind all of these. So at the moment, over a third of all of our clients are citing cost of living as the reason for their financial difficulty. Clearly, I think the kind of second part of that question in terms of emerging risk, again, isn't going to be a surprise to anyone. So average utility expenditure for clients now at 49% year on year, clearly higher since records began on that. And the kind of problem with these clients, they're twice as likely to have a deficit budget, and they're presenting with far more complex needs. So taking up to as long as 3 times longer to complete that advice than a standard call.
So, and have you seen that change really since January, or has that been a recent kind of change? Because I know sort of in the run up to the end of the year, it felt like we weren't seeing maybe what we would kind of expect. I mean, is that sort of like, is it the start of this year that sort of has crystallized things, or were you seeing it into the end of last year as well?
Yeah, so kind of Q4 last year is where the uptick started, and kind of January we've seen a further spike, really. I know we've kind of been talking about this tsunami of demand. It seems like forever, actually, after a few false dawns. But generally, and I know speaking to my partners who we work with closely, kind of Q1 this year was where we're really expecting the spike.
And you mentioned energy costs there. I mean, Ian, I was going to come to you into like energy, utilities, water, etc. I mean, that's obviously been going on for a while. I mean, what have you been hearing from the people you interact with? I mean, is this kicking in, or is it? I mean, has it changed since the start of the year, or is it just more of the same?
Yeah, so you could probably say in utilities, it's been going on now for the last 2 years, starting predominantly when you saw a number of energy companies exiting the market, and seeing sort of a huge increase in predominantly gas prices, which then had a knock-on effect to electricity prices. And then you've got an immediate impact on the direct debits that people were paying, and certainly it's not been unusual to see people's direct debits sort of doubling and going up by more than 100%, which is a massive outlay, even for those people that have money available to save every month. So, we're still seeing prices going up, but we're also seeing a market that used to be pretty competitive now is very stagnant. So you're not seeing lots of new tariffs entering the market. You're not seeing the market be competitive in the way that it used to be. So from a customer choice point of view, you're not seeing a lot of that. And inevitably, that's meant that the good prices that we were seeing just aren't around now. There's a little glimmer of hope, though. So we're certainly seeing, as a result of people cutting back on the energy that they've used in this winter, those sorts of blackouts that were talked about last year, that seems to have sort of tapered away. So for everybody that's bought a sort of a generator or an external battery, I don't think you're going to necessarily need to use that this winter. And we're seeing sort of future prices on the gas and electricity markets looking a lot healthier as well. So I'd say towards the end of this year, we might see more competition. We might see more tariffs, but people entering the market as well. I think that's slowed down, and we're seeing a lot more regulatory pressures on new market entrants as well.
Yeah, I suppose so it sounds like we're seeing some moderation in terms of energy costs that might kind of help, but I suppose we do have in the background, so we've got the inflation and we've got interest rate changes. I mean, Kevin, I'll get you to comment. I mean, certainly across, either the clients you interact with or from a debt advice industry point of view. I mean, what have you been seeing?
Well, I think I'll just echo some of the stuff that Jamie's been talking about. And the other thing we've got to bear in mind is that a lot of people take some time to go off and seek help and advice. So there can often be a time lag. But most definitely we're seeing at the moment some significant rise, particularly in things like deficit budgets. So across the sector, that may range from sort of 15% at the lower end. I think Jamie's figures are around about 34% from their monthlies. But Citizens Advice and National Debt Line that may well deal with a different demographic, close to 50%. And in addition to that, the top reasons for debt are often cost of living or energy related. So people presenting with priority debts now is much more common. And other firms, so people like PayPlan, have been identifying people in the middle income brackets, household incomes over £60,000. So we're seeing a shift in demographic. I think obviously the low income households are hit hardest. And inevitably then you see particular types of debt, credit union information and the like. But I think with mortgages going up and that being slightly tapered in the sense that when you look at some of the economist view, that's taking place over several years. But where it's going up by £300-400 a month. And similarly, I think the forecast that Credit Connect talked about today was average household bill on energy going up by just over £200 in April. If you're horizon scanning, Chris, there's still some bad news around, even if the headline inflation is beginning to come down.
Yeah, James, just to bring that to life, Kevin, I think so. I asked to our BI guys to segment the energy referrals, and whilst the charity, you're right, it's kind of around 32% of deficit budget. For those energy referrals, it was close to 60% deficit budget, which represents a huge challenge for us. Interestingly as well, and this is slightly moving away from the energy, we're seeing a new cohort of customers emerge, and I think they're being termed the newly financially financially vulnerable. These people never been in financial difficulty before, being squeezed by cost of living, food, gas increases, and this population are leaving it far too long to seek any help. So kind of the lack of awareness where to go, combating shame, stigma. So really that's a real focus of ours in terms of that engagement with our partners to get help earlier. Really.
Do you think that it's going to change the fact that we've got these changing dynamics and affordability, the assumptions around affordability at the onset, like this time last year, were probably not correct if you were to do them now? I mean, is it going to change businesses like lenders and energy utility companies' business models in terms of how they need to interact with people? I mean, either from an onboarding point of view, but then also from a treatment point of view as well, in terms of just the fact that they're going to have more people. If it's water utilities, they're going to have more people they're going to have to deal with. I mean, is it going to fundamentally change? We're going to have to change business models as a result. I mean, Ian,
it's not just some of the if you've seen the consultation that's out with insurers at the moment that closes in early March, right? That's requiring them to identify people in financial difficulty who may be dropping critical insurance cover for a sector that historically hasn't stayed very engaged with its customers. Motor finance could have been accused of that before, where they've got a set of keys, can repossess the car, stay one step removed. So there's a lot of industries at the moment that historically haven't been regularly engaging with their clients, like some of the retail credit and credit card firms do. Now that is being thrust upon them by the Consumer Duty, and that ability to stay engaged and use and share data, the tell me once approach, where we can reciprocate data from different parties that have been made aware, and how that information then can be readily reciprocated.
Yeah, I mean, certainly that's changing from comprehensive to third party can be a risk as an example, right?
Yeah, getting rid of the bells and whistles can often be it, and that should be the first port of call rather than somebody essentially dropping their building cover or their motor insurance.
Yeah. Well, what about in the collections space in terms of Ian, I'll come to you just in terms of energy and utilities. What do you do? I mean, what about there? I mean, are we going to have to change our processes as a result of that? I mean, because sometimes, certainly in water, we're just on a previous session. They obviously don't get a choice around which water company or which customers they come through. But you have to react to the fact that you might have higher delinquencies. I mean, and it might change pricing as an example as well.
Yeah, certainly. And I think there's two different factors there. So you're seeing, certainly in the energy space, the regulator putting more pressure on the energy retailers to be more financially robust. So they've certainly been stung by lots of criticism as to how they've regulated the market and how they've dealt with competition, how they've let people into the market, and they've reacted to that. And I know of at least 2 or 3 that wanted to enter the market this year that were pretty financially robust as far as their models were concerned, that were rejected. So we can see the regulator now saying, well, hold on, we need to see a lot more cash and a lot more sort of commercial nous from you before we're going to let you into this market. So that gives an indication of what the regulator is saying in that respect. And then equally, you're seeing huge pressure, political pressure being put on the regulator and the energy companies as far as the end of the collections process, where there's been a lot of chat about the force fitting of prepayment meters. So certainly what I've seen over the years is that that's a last resort for energy suppliers. They don't want to enter people's properties. That costs them lots of money. It gets the customer very disengaged, and of course it sort of leads to complaints as well. So from what I'm seeing, they're looking to change their model as far as collections are concerned, but where they do struggle is a disengaged group of customers that are just not responding to them. So in the collections process at the moment, they can have between 15 to sort of 25 different engagement points. So where they're looking to sort of get something from the customer and they're just not getting anything back from them at all. So I'm predicting that we'll see a lot more different engagement opportunities rather than the traditional letter call, and seeing a lot more sort of engagement and offering in different language as well in the engagement to sort of show that there's a lot more help available rather than the normal threat increasing and looking to sort of create a little bit of a point of anger rather than help?
Yeah, I mean, and I suppose consumer duties coming through. I mean, Kevin, do you think that must be starting to sort of start to change the way we start to look at these things? I mean, really across multiple industries. I mean, it's quite a change of thinking, isn't it? Just to Ian's point.
Well, I think the UK regulatory network, UKRN, that sits over a number of the regulators we're discussing, so the FCA being an obvious one, but Ofwat, Ofcom, Ofgem, all fit within that. And there used to be lots of shades of grey in here, particularly around things like vulnerability, treatment paths, but I think we're beginning to see a lot more consistency. I'm involved with the Fairness Group as well, Cabinet Office, and some of their work, the good work that was done by Steve Coppard and his team a while back, is beginning to see a lot of consistency come through. But inevitably, it takes time to actually get these working practices into play. And I think some of the more obvious areas that I've seen, and this was particularly true with things like broadband, was just a very low take-up of things like social tariffs, the priority service registers. So I think there's a huge call to action to make sure that actually what's called debt prevention, actually making sure people are on the right tariff, the right direct debit, is still a key challenge. And some are laggards in that, others very early adopters. And bizarrely, one of the firms that have been discussed regarding prepayment meters actually scored one of the best in its industry and had the least intrusion. So, I don't know what that tells you overall, but that is going to be really important. So some of the data sharing to me is absolutely critical. If somebody's on a priority service register for water, that's probably going to be a very strong indicator of where they sit for energy. So if you're going to cut their water off, either because it's maintenance work or debt related, then this information should be relevant elsewhere. And we've heard people earlier on about data analytics, machine learning. There are some really obvious common sense things that said, why aren't we sharing more of this data, particularly where it relates to particularly low income, vulnerable customers, and make that more readily accessible?
I mean, we seem to very sort of focused on the back end of the process. I mean, the media was very focused on the recent example, on the back end of the process and what kind of happened. I mean, do we really? I mean, how do we move that focus almost into that pre-arrears?
Really good one. I think actually Ian from StepChange actually reported the other day from an FCA podcast where we talk about sludge practices. And although the FCA wouldn't be nailed down on what it is, but if you think about average call waiting times, what they've suggested is if you wait any longer on the back end than you do on the front end, then that's a sludge practice. So if you imagine how quick people are to onboard customers and make that frictionless, then apply that same principle to the back end, that probably focuses the mind of pretty much every sector where you've had your call is important to me, but we're experiencing exceptionally high demand at the moment, which probably makes my blood boil more than anything else.
I mean, how much focus do we need to put on that pre-arrears in lifetime sort of early avoidance type process? I mean, if it sounds like we don't have enough, right, Kevin? I mean, Jamie, what's your kind of view on that? I mean, how much of the debt you see coming through the cost of living challenge, how much of it could have been minimised by having earlier intervention upstream?
Yeah, I mean, so we did a poll recently, and 92% of our clients said they didn't contact us early enough. On average, they wait 12 months to get debt advice, and it's been a problem for many years. I'd say from a consumer duty point of view, kind of the contact I've had, most of my partners, has been around the requirement for increased engagement. And let's not kid ourselves in this, it's a massive upgrade on current regulation. It's huge in terms of change delivery programs with all our partners, ourselves included in that actually. What could it mean? So, the need to understand your client more. So ultimately that could in the collection space, that could be more income expenditures. But I think the real focus is on kind of pre-delinquency, avoiding these clients getting into financial difficulty in the first place. At StepChange, we're driving and developing new digital tools to really support in that space. So if there's any creditors on the call, definitely get in touch with me if you're in that space too.
And it's going back to, I suppose, the recent media kind of discussions around forced payment. I mean, it's more generally on the collections industry. I mean, do you think? I mean, a lot of the discussion we've had, even over the last 3 sessions, have been about how do we support customers, and how do you give tailored support to customers the best you possibly can, and all our processes have been like, how do we do that? Do we have a PR issue from an industry point of view? I mean, and what do we need to do to try and do that? Because I know there was an awful lot of attention in the media around what kind of happened. I mean, but we know from the inside around all of the work that's gone on to sort of like treat customers as fairly as we possibly can, and it's night and day different than it used to be. So, I mean, what do we need to do differently as an industry to help people understand around supporting customers and make sure the customers aren't fearful in terms of like talking to us as well? Ian, I mean, did you want to?
Yeah. So I think absolutely we've got a PR issue from a collections perspective, and I think that that's across a number of different areas. So whether it's as an industry talking about collections without people thinking it's the stuff they see on Channel 5, the sort of can't pay, we'll take it away sort of scenarios. And equally, my experience of good practice is stifled in most businesses because they're scared of talking about how good they are at helping customers that are in debt. So you just think about awards seasons, and you see what businesses do when they've won an award for customer service versus when they've won an award for collections. And you'll see that business shout it from the rooftops when they've won an award for customer service. If they win an award for collections, it's maybe because they're fearful that they don't want to be known as great at collecting debt. And I think for me, that's definitely a PR issue. It's also, I think, a bit of a mindset issue around what is collections. And I've always seen collections as a service. You're trying to help somebody in a situation, get out of that situation, and hopefully recover that customer from the situation they're in and make them a customer for life. So for me, absolutely, there's a PR issue. There's a lot more I think we can do in understanding the psychology of somebody that's in debt to engage with them earlier, try different communication techniques, but also the language that we use is vitally important. So, like I said earlier, that process of getting angrier and angrier by every message you send them just is so difficult for somebody that's burying their head in the sand. And if you've ever been in debt, that fear that you have of the letter coming through the door, it's very recognizable, and it's very difficult to manage. So I think engaging with people and maybe also trying to navigate online communities a little bit better also. So I think it's trying to engage differently with different language and trying sort of omni-channel digital means also.
I mean, Kevin, I just go to you in terms of your thoughts. And we've discussed before around how the lines seem to be blurring somewhat between, a debt advice process, and it's a regulated debt advice process, and then how the support process happens internally within collections as well. And so like how do we need to start thinking about it, and what do we think from a PR point of view within the industry as well?
So I think the PR part, I mean, I just probably get this off my chest right at the beginning. I think austerity measures have meant that in many instances, some of the gatekeepers have just become rubber stampers. So when we look at some of the recent sort of red top, high level publicity, and it's got to be fair to some of the guys involved in this process if they followed due process, that where you've identified a 92-year-old lady that should have been on the priority service register and you've got to go to court to get the thing rubber stamped, and nobody's doing any due diligence anymore. You've got to do a bit of navel gazing all the way up and down the process, and that element of common sense seems to have gone by, and we see it everywhere. NHS, it's whoever you're calling now, some of these practices are pretty poor. Now, where I think the key element I've seen a lot of collaboration from the pandemic is a lot of the creditors now have got relatively smooth processes, as probably Jamie's referenced already, into debt advice, and it's getting smoother and slicker They're attempting to do it further on. Language has been poor. I remember when persistent debt came out, people who'd never ever missed a payment before being called a debtor was like slapping them in the face, and they got very angry about it all. But that was prescribed language by the FCA, not by the creditors. So, and I think, again, the regulators probably learned from that. So some of the work that StepChange did with Amplified Global on mixed messages report said actually a lot of creditors are trying to do the right thing, but still missing the point because of financial literacy levels, financial numeracy levels. So we've seen players like Amplified and Play Numbers and others come in. And that again is influencing things like the Consumer Duty that says, I don't want to hear all the cultural rhetoric, as Ian said. I want to see some action on the ground. Is it changing your letters? Is it changing the language of the agents? And particularly with technology like speech to text, you can then go off and analyze afterwards, are a cohort of your agents just speaking over the top of clients who don't actually understand what they're talking about?
Yeah.
Similarly, if you use things like digital messaging for WAV type files, it can actually be read out with the correct punctuation. So the meaning of the letter actually is completely different from somebody who's got low literacy reading it and saying, I'm just bemused from, line 1 of this hello letter. So there are a lot of things going on at a grassroots level. And I think some of that PR should be applauded. But I think Ian's right. Sometimes, over promoting what you're doing in collections probably doesn't get a lot of hearing. And it's the contact center as a service bits when everybody's talking about exceptional customer service. When actual fact, we should be improving some of that, which is clients do need to be encouraged to engage, identify and look at the tailored journeys. Because for things like gambling and whatever, we're not picking it up early enough. It's only when it gets into the latter stages that often people are having to do jobs that they haven't really been well trained to do.
Yeah, it seems like you can push some of that stuff upstream and sort of like blur the lines between what is collections versus not, and sort of like, but it's around customers, isn't it? Customer outcomes that are sort of coming through.
Yeah.
And you mentioned earlier a little about deficit budgets and just get the groups. I mean, it's like, are we seeing more deficit budgets coming through? And then I think there's a question really around, if you have a deficit budget, what do you do? Because you're already in a deficit. I mean, you can obviously send it to debt advice. I mean, but do we need more tools in the toolbox to help things? I mean, Jamie, I don't know. You obviously see a fair few in terms of from a debt advice point of view, in terms of like people who are in financial stress. I mean, do we need more tools in the toolbox? Do creditors need more tools in the toolbox? Do they need to think about things differently?
Yeah, absolutely. And again, this feels like one we've been talking about a hell of a long time for us. I don't know how many sessions I've been on where this has been, and this year more than ever, I think we're sort of, as Kevin said, the numbers are increasing. It remains a huge problem for the sector. So at StepChange, our access have been enabling access, kind of self-help access, support to clients that are in deficit, but we're working with Income Max as well. They're absolutely fantastic. I'm sure you will work with them. There's only so much funding. The problem's certainly bigger than the amount of funding that's available out there. It's societal, ultimately, that's going to drive that change. We are working on some digital tools that firms can use to support clients. But ultimately, the problem is a growing one, and it's huge already.
I mean, do we need to think about how we manage? Do creditors need to think about how they manage customers differently? I mean, I think we talked about in the previous session around, doing it from a brand point of view, or maybe take a longer term horizon in terms of like forbearance plans. I mean, do you think those are options? I mean, because obviously they've reached a tipping point when they've come to you guys.
Yeah, I think so. We've had some industry sessions with creditors or UK Finance where I suppose the problem is trying to find a common practice, and I think that's why it's always fell down. But absolutely, I come from a banking background, and we had a robust process in place for deficit budgets where it's not indefinite. You don't keep it on your book indefinitely, but I think the problem needs to be revisited at senior level, UK Finance, get the creditors around the table, because this is only going to get worse to the back end of this year.
And I mean, Ian, I was going to go back we talked about, so Jamie was just talking about the number of people coming through, basically sort of like, I suppose, got issues with energy, and the fact it causes a lot of issues and a lot of volumes that are coming through. I mean, what's the importance, or how do we get customers to engage when they got an issue and get them to engage early? I mean, what are you kind of been seeing, or are ideas you've got?
Yeah, so I think it does definitely go back to the brand and the tone of voice of the brand. So if you are seen as a helpful brand, and if you are seen as communicating, at the right level, that's really clearly understood from the outset, whether that's onboarding or talking about how they're helping their customers. If you have multiple ways of contacting you, if you have an online community that has great stories on there about how they've helped customers in debt, I think that's a really great place to start. Actually, equally, if you take a look at the website, and you can see they're partnered with StepChange and multiple other sort of third-party experts in this respect, and those are the places I think people are looking to see, is this energy company looking to help me? Equally, I think as the market starts to become more competitive later this year, I would hope that the switching sites, rather than just looking at the tariff and the direct debit and their green credentials, they should start looking at how helpful they are when you get into debt. That, for me, would be a great indicator of, if I do fall on hard times, how is this company really going to engage with me? So they can look at the complaints, they can look at the sort of support that they offer when somebody gets into debt, and they can start to rank that. And then when you're looking at joining a new company through a switching site, you can quickly see that, and you can balance it between how much I'm going to pay and what's going to happen if I get into trouble.
Yeah.
No, Chris, on some of these things, I think that point that Ian makes there is really important. And my background's obviously credit referencing, and it's very, very hard. And I'm probably not the world's best on Google, but I'm fairly proficient to go out and find examples where somebody is in financial difficulty, of what this means to them on a more holistic level. And credit reporting is very important, particularly in energy, water, and other areas on it. So what will happen to me? How will this look? Some of these social tariffs and co-investing, I've seen some good stats this week of this Affinity Water around their co-investing with their clients to help them get out of debt. What will that look like on their credit report? Who do I pay over somebody else? That's not just about priority, because a lot of people will pay somebody who is credit reporting, but not somebody else like HMRC or similar, because they've grown wise to what has an adverse impact and what doesn't. And buy now, pay later is incredibly important in that at the moment. So, I'm working with Experian at the moment, who are now providing value-add data blocks so that creditors can actually understand what all these transactions actually mean. Because Jamie's teams and others, PayPlan and others, are having to try and explain, when a client comes to them, what does this solution over this solution mean to me on a long-term basis? And if you took that much further forward into pre-arrears, that educational process doesn't look quite so foreboding. But we don't see many examples in the public domain of this is what it looks like for somebody who's in early arrears, serious arrears, or got multiple judgments, or indeed a threat of serious enforcement action or repossession.
But it seems like the excuse me, it seems like the consumer duty piece, and at least from a theme point of view, is starting to pull the stuff together that you've been talking about.
Chris, they're spelling it out. So if you've seen the letters this week to debt advice and to debt collection, debt purchase, and debt administration, which include a lot of BPO firms in that doing first-party collections, and you break that down and you read between the lines, it's basically said, we're getting fed up of having to spell this out to you. So there's a breathing space scheme, and pretty much the only people who contribute to it meaningfully are StepChange. I think they're about 64% of all registrations at the moment. You've then got income optimization, which is you should be using this as a best practice. And so you go down all of the paragraphs they're now putting into it. They make it context specific to the sectors. They're pretty much laying it out in front of you. This is what forbearance looks like. This is what vulnerability assessments look like. And woe betide you if you're not doing it.
Yeah, I suppose where I was going with the question I was going to ask you, Kevin, though, is like, how ready are we? I mean, you sort of given a little bit of the answer there. And so, like, I mean, how ready is the industry for the changes that are coming down?
I'll pick out three sets of words that came out in the recent letter from Sheldon. overconfident, superficial, and shuffling MI and data. So some of the key messages, and then add to that, not including the distribution chain or the supply chain, you've got some really key messages that we are overconfident. So the 60 firms they speak to, which are the big guys, they're now about to go and survey 600 of the smaller guys. And believe me, it's likely to be the high-risk firms they contact first. So collection companies, BPO companies, debt advice and debt solution providers probably charging fees. If they could bring the IVA providers in, they would, but they don't regulate them. So they're doing the next best thing and finding the people who refer into them. So they will be looking at all of those elements there to say, how superficial was your implementation plan? How seriously did you look at the cohorts of customers that are most at risk? And indeed, Sheldon made a speech yesterday, which I think there's two statements in it, which pretty much set this out. We will start at the highest risk businesses, and we will focus our attention in the areas with the customers that are likely to be most vulnerable. And I think that's a pretty good starting point if you haven't got there. We've only got 5 months to go, but the 30th of April is when you've got to start talking to your brokers, your intermediaries, and everybody else that's in your supply chain. That doesn't really leave an awful lot of time.
Yeah, I mean, Jamie, I was kind of interested in your view. I mean, obviously, it does apply to you guys as well. I mean, I imagine you've got a program working on it too. But I mean, what's your sense in terms of, like, particularly when you're talking with creditors, in terms of like readiness levels around it?
Yeah, I mean,
some of what we've already talked about, right?
Yeah, I think Kevin has kind of hit the nail on the head with everything he's just said. But coming back to the original point, these are massive change programs. So for the banks, this is huge, And I think in terms of the kind of level of investment and resource required to achieve this standard, you will potentially see casualties here. We're talking the level of change that's required is significant.
Yeah. And I suppose one of the questions we talked about before was around financial inclusion. And we always talk about cost of living, and we talked a bit about, I suppose, different types of customers. Some of those we talked about digital processes versus manual processes. I mean, how does financial inclusion and inclusion come as part of this, and maybe even in terms of like some of the guys you interact with as well? I mean, because we've been very sort of like driven over the last sort of like 2-3 years we talked about already around kind of putting in digital processes. I mean, do we need to make sure that we include everyone, but also include everyone across the financial spectrum as well?
Yeah, and I think so. To be clear, with energy and water, there isn't really a choice for those companies. So with water, if you live in a region, you're supplied by a certain company, and they have to supply you. And with energy, you can offer terms of trade. You can go through a credit scoring process and assess that customer, but that's all you can do. You cannot decline a customer. So as far as inclusion is concerned, those two sort of industries aren't quite the same as other sort of financial institutions. Equally, then I think where you've got other levels of inclusion, you need to be thinking about how we're managing collections processes and how we're sort of talking to customers, I would say.
I mean, so specifically for the energy companies, is just whether do you do so essentially risk-based pricing for I mean, and is that fair for people who maybe have got less money? I mean, I think I know you've got social tariffs, but I mean, there's also a bit of risk-based pricing that goes on.
And that's a really good point, actually. So in water, there's social tariffs. In energy, it's something that the regulators resisted up until now. And I think there's other schemes certainly that are in existence, but I would argue that the schemes that are in existence for customers that need it most are not marketed half as much, or even anywhere close to the marketing machines that sort of look at the brands themselves and the tariffs that they're pushing out there. So if you look at how much money is spent on marketing, the fact that a customer with a prepayment meter can indeed switch to another supplier, versus the fact that an energy supplier has an app, I think there would be millions of pounds of difference in those two messages. So for me, I think it starts with how much money are you spending on telling your customers about all these wonderful schemes that exist that can help them when they hit hard times and what they can do about it, versus all the other wonderful things that you do as an energy and a water company. Equally, I think digital versus traditional. I'm a big advocate of digital, and I think it solves lots of problems, but it's not a single solution, and there's still a huge number of people that the energy and water suppliers look after that are not. So I think you kind of take the savings and the improvements that you make in the digital field, you look to educate as many customers as possible to take advantage of digital, but those people that cannot access it, you take a load of those savings and you introduce new services. So I'm seeing a lot more sort of face-to-face services coming back into things. And I think take that saving that you've taken from the digital service and get people out there knocking doors and having face-to-face conversations with people that are really struggling. They maybe English isn't their first language, and really trying to help them as much as you can, rather than just taking that money, using it as profit to give back to your shareholders.
Yeah. We heard a little bit of that, I think, on the one of the earlier sessions, a little bit about like local programs as well, which was I thought was quite interesting.
Yeah.
I mean, I think one of the things we talked about over the last sort of like 3 or 4 years been the whole concept around flexibility, and certainly sort of 2-3 years ago, and everything was very stable. We weren't probably as flexible as we needed to be, and we've had a huge amount of change. Now we're more flexible. I mean, what do you think the state of readiness is now, given that we might have more change that's coming on in the future? I mean, Kevin, I don't know if what your kind of view is on that in terms of like, there's so much has changed over the last 3 years. I mean, are we more flexible now than we used to be? Do we need more flexibility?
I think we lost a little bit after the pandemic. I mean, you and I have been on the same panels many times before. I was very impressed for many firms, public sector and private, at the responses when we had to move lots of people to hybrid working or working at home, and then looking at all the consequences of that. I think afterwards, I think we've not maintained that continued agility, if that's the right word. And we're still hearing a lot of rhetoric, but not a lot of good examples of scaled deployments, and encouraging convictions in delivering some of the aspects of it at the moment. And that's why I'm slightly nervous to say that we are continuing on a sort of a path of, more digital transformation, more integration, better data. Because I'm not actually, in reality, I'm seeing some good proofs of concepts, but I'm not seeing. I think there's a question in there from Lloyds Bank there around some of the new customer cohorts and customer segments that we're seeing. And we need to be talking about some of these. There is a danger that we get too tied up in the lowest income groups who do need help. I totally agree with Ian. But there are other areas where you're not eligible for certain tariffs and the like, but people need just as much help. And indeed, if they've not been used to being in the debt system, quite often make really stupid mistakes in terms of who they pay first, who shouts loudest. So I think, some of these things can be a little bit cyclic, but we've still got the same fundamental problems in the collection sector that your won't pays still need to be dealt with and separated from. I would like to pay, but I'm struggling to engage. And what is the behavioural science we need to bring to that to get people to engage? And I think we've scratched the surface of that today around better communications, better tools, education. But it's not widespread at the moment. I think that's why a lot of people are focusing on vulnerability, or those where there is I'm vulnerable to something. And I think in your previous session, Chris, you highlighted this. Vulnerability can get bandied around too widely, and people don't like to be badged vulnerable. But we need to get clever at things like accessibility and other areas where people are willing to disclose in order to get a better service.
Yeah.
And the Consumer Duty does ask that, have you met the consumer's objectives? And a really obvious thing is if you're not asking them what their objectives are, it's very unlikely you're going to be able to hit them.
I think that the point around the different cohorts come up a few times over these 4 sessions, which I think is kind of quite interesting in terms of like, I mean, and I think just what you're saying there is that do we need to have different paths, and are we thinking enough around having different paths for different cohorts? The fact that it has changed, and do we need to have slightly different approaches, which is kind of a little bit what the questions are kind of alluding to as well. I mean, Jamie, I think you made the comment earlier as around those people who are maybe haven't been in collections before, they're suffering under cost of living challenges, and we might see more of those, and it seems like that's a growing group. I mean, how should the journey be different? I mean, it's an education element, is it?
Yeah, and it's multi-pronged in terms of the channel here as well. So I think digital's got a big role to play in that cohort. And I suppose if you kind of look at positives, I know there weren't many post-COVID. I think the emergence of really sophisticated digital journeys that the creditors put together is a massive positive, and that was expedited definitely by the pandemic, which gives the industry a good state of readiness actually. For that increase in demand. But coming back to the question in terms of, yes, absolutely. In terms of pre-delinquency, I think Kevin said, these customers aren't in arrears yet, so the approach cannot be a standard collections approach. We're developing tools around money health check, which is a new tool that StepChange put together, which is a far less intrusive way of getting a customer to think about that journey. So it's tools like that will make a real difference.
Yeah, and there's just a couple of other questions came in around using ONS data, I suppose, within expenditure or affordability assessment. I mean, is that relevant? And that seems like that's a bit of a problem. The fact that it's looking backwards rather than necessarily looking forward and factoring in inflation. I mean, that's come up a few times. I mean, is that something that people are now looking for? Because it's not just what you can afford today. We talked about this before. It's about what you can afford in 6 months' time. I mean, how do we best go about sort of assessing that? I mean, Jamie or Ian, maybe comment.
Yeah, I guess the first thing I'd say is that data sharing in the energy and water space is not at the levels that it should be at. So there've been data sharing since sort of 1999, but we're still at a stage where there's still too many energy and water companies that do not share data today. And we know that people that take energy and water are underserved as far as credit reference is concerned. That we see them as there's more thin file customers within the energy and water space than any other served industry. We're talking about an industry that needs to identify vulnerability. We're talking about an industry that needs to understand the demographic that they're serving and to deliver more bespoke collections and more bespoke services. Well, it starts with seeing what this customer behaves like and what they're experiencing out of the service that you're delivering to them. And we know that the data that energy and water companies has at their disposal is pretty limited. We see lots of occupier customers. We see lots of Mr. Mickey Mouse and all these other names, because it's not like you haven't applied for a loan. You get the service regardless of whether you tell them who you are. So to me, I think there should be a rallying call to increase the amount of data sharing participants across the industry, so that we can get better at seeing what the customers are experiencing that we are serving.
That sounds like there's a bit of an incentive, right? How do you incent data hygiene from that point of view to really understand what's going on, which can then help downstream in terms of collections piece?
Yeah. And the regulators keep talking about you need to get better at proactively identifying things, but they haven't quite gone as far as to say you should be credit scoring and you should be credit data sharing. They've not gone that far, but they keep putting pressure on them to say, what more can you do to be more proactive?
Yeah. Okay. The one other question I'm going to direct to you, Kevin, which was what verification do DMCs complete regarding expenditure?
So I'll talk about it from the regulated firms that really provide debt solutions. If I can do, which would be my members and StepChange's pay plans of this world. So you had a discussion in the session before about the standard financial statements and that being used as the basis in England and Wales. And what we're seeing now is an increasing number of firms now using open banking, credit reporting to support a data gather process, and that can, typically take 50 minutes to complete, and that will be intended then to be supported with additional artifacts, as we call them, with regard to proof of income bank statements and the like, and some can act as substitutes for others, and some of them can serve as sort of anti-money laundering type checks if there's a likelihood that somebody may go into insolvency. But as a rule, we have to be able to be flexible so that you can deal with the lowest common denominator, which may be a set of selfies that somebody's got with something between their feet where they're photographing bits of evidence, ranging to some high sophistication. And, for some of the members here, 84% of the clients have got smartphones. They've got single sign-on. They can open to 2.8 bank accounts, which is the average now, and access other information and transfer it through. There are mixed philosophies, I would say, Chris, between different firms, between do you ask the client a lot or do you use as many third-party sources as you possibly can? So we've got some providers doing direct access to HMRC. They can use the bank statement to look up the car and the car valuation because the DVLA data's there, national insurance numbers are there. So some really clever stuff, but equally well, you've got to deal with the lowest common denominator, and that's got to be risk-based. So in reality, particularly where you've got, and I think was inferred earlier on, borderline cases between somebody being a deficit budget, and I think, for the collection folk that were in the previous discussion, how much drill down you do, then skilled debt advisors will know where they've got to go off and do clear explanations of either excessive expenditure, but more worryingly, understated expenditure. So it feels like they are not putting enough in for them to heat the house or feed the kids.
As everything in collections, it seems like it gets increasingly complicated as we get more channels, we get more pieces of information, which is just it just seems to be the way the collections is, because that's real life, isn't it?
Yeah, we do tend to still get a few bloke in a pub stories where I once knew and I got an income and expenditure through that wasn't very detailed or was missing X, Y, and Z. We know they've got a holiday home and a motorbike and something else. I'm sure everybody can come up with those stories along the line, and different providers deal with different specialisms. So, my experience dealt with a high proportion of homeowners. So doing land registry checks and a lot of other things are looking at the assets is a key part to this, because anybody with assets at the moment is still incredibly vulnerable to quite aggressive enforcement action by virtue of the fact that you've got to get the charge or get the attachment of earnings on it. So, that's where an advisor should be earning their keep in relation to what is the right amicable process to go that pacifies all the creditors involved.
So well, I mean, I think we might, I don't know if we've lost Jamie, who's gone off camera, but hopefully not. But I did want to thank the three of you just for spending the time going through it. I mean, it does feel like, cost of living is a continued challenge. It feels like it's the challenges are continuing. It doesn't seem like it's going to moderate soon, although it does sound like maybe some green shoots in terms of energy, hopefully. But we still have back end of the year, and the economics seem to be flowing through. So we know it's a challenge for folks, and it sounds like it's affecting a new cohorts of individuals as well. So we just got to think about how we sort of change and react to that from our collections processes, albeit with probably consumer duty, just offering us at least some guidance and heavy impetus to make sure we put the right changes in place.
Chris, if you just look at Colin's front page on Credit Connect today, you've got some worrying stories there just around the increased use of credit and the like.
Yeah,
so there are. There may be a couple of glimmers, but there are an awful lot of indicators there that suggest these barometers of early arrears, increased usage of credit, aren't taking us in the right direction.
Yeah, and of course we have knock-on effects as well. So if firms start going down, then that has impacts on the employment and the income on the income line on the I&E, doesn't it, as well? So it's the knock-on effects are actually sometimes more unpredictable than the actual direct ones. So, well, the three of you, thanks very much. Really appreciate it. I think we're almost at time. Well, yeah, thank you. And if there's no more questions, I think we're going to sort of close it there.
Yeah,
so,
just a quick one from me, Chris, if that's all right. So, just wanted to round off and thank everybody for their support today. Really good, especially our sponsors, Cool Miner for their sponsorship of the session earlier, and also Webio for the sponsorship of the session and the overall event. Really appreciate that. Also, obviously, want to thank all of our speakers, not just Jamie, Kevin, from this session. Sorry, and Ian, of course, as well, and yourself, Chris, been really good, really helpful. Just want to flag up as well, we've got lots of other events planned this year, mainly virtual, not because of the train strikes, but yeah, just we got a lot of attendance on this one, again, really well attended, so hopefully it justifies my thoughts on keeping some virtual events out. But yeah, we've got end of March, we've got the Online Lending Technology Think Tank, which we hope people like to register for that if it's relevant to their end of the industry. I know some people cover collections and lending and credit. So that's one event. We've also got another version of this collections event in early July for the holidays break up. So we're going to run another one of those then. And we'll also do a commercial credit business one as well. We're looking at one face-to-face one in May, small event as well. So that's another thing. We'll run another lending one in September, and then we'll go back to face-to-face at the end of the year. Hopefully we'll all be well and there's no more pandemics emerge. But we've got the face-to-face credit and collections technology think tank. That's our face-to-face version, very similar format to this. Obviously you get to network and meet people before and after, which is the added bonus. So that would be great. And then finish off that evening with the Credit and Collections Technology Awards, where we'll be highlighting innovation across the year. And there might be some of the companies who've spoken today might be involved. So yeah, lots of interesting things, as you all heard today, happening across the industry. So but yeah, let me just round up by saying massive thank you to all of our speakers, especially Chris Warburton, for all the hard work he puts in. It's really appreciated. These events don't just appear. We put a lot of effort into it. We rehearse it. And we really make sure the content is worthwhile. So massive thank you to Chris for that and all of our speakers. I'll just round up and say thank you everybody who's tuned in, contributed, asked questions. As I mentioned, some of these videos will be rerun, but we're also we're putting them on our YouTube channel as well, so we're getting a bit of traction with those. But we'll also do a write-up of this event really briefly with some questions and answers from that. But I'd like to end by thanking everybody for their time and hopefully catch up with you all either face-to-face or virtually soon. Thanks a lot. Goodbye.